Hi traders, and welcome to Learning in 3 Minutes. Today in 3 minutes, I want to help you to understand the concept of leverage, as it can be a very confusing topic, so I will cover it in two separate videos. It's essential that you watch both. In the first part, I will explain what is a leverage, how leverage affects your margin, and in the second video I will explain margin percentage. We will also cover margin call and margin stop out. These are just few examples of leverage: 1-to-1, 50-to-1 or 400-to-1. It's important to remember that high leverage would give you more buying power, so you can potentially enter larger positions and have larger exposure. That means larger trades. With larger trades, even a small market move can result in a significant profit or loss. So leverage changes your buying power. Your $1 in your account will have greater buying power if you increase your leverage. With a high leverage, your margin requirement also decreases. Maybe you're asking, what is a margin requirement? Basically, margin is a down payment for open trades. If you open trade in a market, you need to put down the margin, which is your exposure divided by your leverage. So you have $1,000 in your account and you'd like to start with 0.01, so 1 microlot of Aussie trading against the US dollar. 1 microlot is the smallest trade size. So you will have $1,000 exposure in the market, but how much margin do you need? Well, exposure is $1,000, your leverage is 1-to-1, so $1 in your account has $1 buying power in the market. This is a calculation of your margin. 1,000 exposure divided by your leverage gives you 1,000 Aussie margin requirement. How would your margin change if you increase your leverage to 400-to-1? Let's have a look. So your exposure is the same, 1,000. Leverage is 400-to-1. So 1,000 Aussie divided by 400 gives you $2.5 as a margin requirement. By changing your leverage from 1-to-1 to 400-to-1, you have reduced your margin requirement from $1,000 to $2.50. It's important to notice that the trade size stayed the same. To recap, leverage affects your buying power. Leverage changes your margin requirement, not a pip value. By increasing your leverage, you are reducing your margin requirement. As higher leverage gives you more buying power, consideration of risk involved should be taken into account. In the next video, I will explain margin percentage, margin call, and margin stop out. Answer the question if the high leverage is more risky or not necessarily. To have a clearer picture about leverage, please watch my following video. See you there. Happy trading!